In this chapter, we will talk a little bit about fraud and internal control systems that companies implement in order to avoid or to mitigate the risk of fraud. And then we will talk about the principles of internal controls, and we will with a focus on cash receipts and cash disbursements, and then we will talk about bank reconciliations. So fraud is defined as any dishonest activity by an employee that would result in benefit for the employee, but at the expense of the company. In this case, there are three factors that actually affect the likelihood of fraud happening. The first one is opportunity. Without opportunity, the employee may not be able to commit fraud. For example, if you are afraid that an employee is trying to steal some cash, the cash has to be accessible to that employee. So the opportunity of stealing the cash will have to be present. The second one is financial pressure. Financial pressure is when the employee tries to, for example, either have some financial problems. As a result, they would need the money, or when the employee has would like to live a higher lifestyle, which would cost more than they can afford. As a result, they would commit fraud. The third factor that affects fraudulent activities is rationalization, and this is where the employee basically justifies their actions, their fraudulent actions. For example, the employee would rationalize and would justify their stealing cash by the fact that the employer or the company, that they are making a lot of money and they are paying them a minimum salary, or they are not giving them any raise while the CEO is getting high bonuses. So they justify stealing cash in this way. Those three factors together, they increase the likelihood of fraud happening. Because of various accounting scandals, the US government, they passed Sarbanes-Oxley Act of 2002 in order to bring in additional internal controls. Now companies are required to not only to have and to maintain effective internal control systems, but they are also required to evaluate them, and they are required to report on the adequacy of their internal control systems over financial reporting. And moreover, external auditors, for example, they are also supposed to evaluate the efficiency and the adequacy of internal control systems, and the companies, as well as the management's evaluation of this internal control system. And after Sarbanes-Oxley or SOX, company executives are now liable for any material misstatements, or if there are any internal control weaknesses. In addition to that, Sarbanes-Oxley created the PCAOB in order to regulate the auditing profession, which was until then self-regulated. Now, internal control systems are usually those are the measures that the company would have in place in order to mitigate the risk of asset misappropriation, basically to protect the company's assets, to make sure that the accounting records are correct and reliable, plus to make sure that the company's objectives, are reached and they are not being affected by fraud And finally, internal controls are a requirement. The companies are required to comply with laws and regulations, and internal controls systems, they would help with this compliance. They help ensure this compliance. There are 5 internal control components. Those components, they start with the control environment, which is sometimes called the tone of the tone from the top, or the company. This is the tone that the company management sets, and for example, saying that they have. This is where they emphasize the importance of integrity and, for example, zero tolerance, etc. And they also explain their ethical values and management's philosophy. We have also the second component is risk assessment. This is the evaluation of the risk of the risks that the company, based on the company's evaluation, which would affect the third component, that is control activities. And that control activities are the actual procedures and activities that the company puts in place in order to mitigate the risk, especially, and it would affect the level of and basically the risk assessment would affect the level of control activities. For example, high risk areas, they usually have additional controls to try and mitigate any risks. And there's also the monitoring part, because the internal control systems have to be monitored periodically, or surprise audits, for example. And this is in order to evaluate and assess their adequacy, and to make sure that they are effective. During that time, information has to be communicated to the concerned parties all across the system. So these are the internal controls, and these are the internal control components that we just described. We have the control environment, risk assessment, control activities, information and communication, as well as monitoring. And relevant information must be identified, captured, and communicated in a form and time frame that enables people to carry out their responsibilities. This is why we had information all across the other components, because this information has to be communicated in time, and it has to be communicated in a reliable and relevant way. Otherwise, the management, for example, will not be able to act upon this information. There are 3 types of controls. You have preventive controls, detective controls, and corrective controls. So preventive controls are the control activities that the company would put in place in order to prevent a certain error from occurring. For example, duplicate payments detection and prevention. This is where internal controls are put in place in order to prevent the same invoice from being paid twice. Other examples are like the limit on payments. So many companies, they have a limit on payments. A certain employee, for example, has a right to make a payment up to $5,000. If this employee tries to make a payment for $8,000, the system will prevent them, because it will decline this transaction, as it would require an additional approval step from the management. However, those preventive controls may not be always effective. They are not like foolproof. Let's take the example of the credit payment of the payment limit. So we said that the employee cannot make a payment for $8,000. However, in certain, what if the employee tries to make 2 payments of $4,000? This is also known as split payments. So at this point, the employee can basically bypass this control. As a result, detective controls would help in identifying cases where this employee has done something like that, and it will identify this mistake. And the same thing can be said also about about duplicate payments. We said that there are preventive controls that prevent the same invoice from being paid twice. But in certain cases, companies might have basically, what if one number of the invoice number was omitted? At this point, the payment will go through, but detective control later on will try to find this anomaly or this exception, and it will identify it after it has actually occurred. At this point, the company can take corrective measures, and corrective controls are their goal is to investigate and correct any detected errors. There are 6 main principles of control activities, and the level of control activities, they would vary based on the assessment of the risk, that based on the management assessments of the risks, as well as on the size and nature of the company and which industry. The riskier the area, for example, the higher the control, the higher the level of control activities that would be required. Generally speaking, there are 6 principles of control activities. Those are establishment of responsibility. In other words, this is where it is important to make sure that the person or the employee who is responsible can also be held accountable for their any errors or mistakes. Segregation of duties means not to have two related roles pertaining to the same task. For example, you cannot request reimbursement and approve the reimbursement yourself. There must be someone else who is providing this approval, or someone else who is verifying the information. Documentation procedures, it simply means that the company should not, for example, make any payments without invoices, etc. Should keep track of numbers of checks. Physical controls, it means that you need to use, for example, safe to save the cash. You don't leave the cash or checks laying around, etc. Keep certain doors locked physically. Independent internal verification, this is where companies use, for example, internal auditors or other third parties from within the company to verify the information feed from 2 different sources, and basically to make sure that the documentations, and to make sure that the numbers or the cash that was handled was correct. And finally, certain human resource controls, which are for example, background checks, etc. So like we said, establishment of responsibility, it is very important. One employee, for example, at a time should handle the cash register, or the use, for example, of passwords and swipe card, because if any error happens, the company should be able to trace it back to the user who made the mistake or who created this error. Segregation of duty, it means that if, for example, if someone, for example, designs a certain computer software, they should not also be the people who use it on a daily basis. And this is, for example, because if I am to design the program and use it later on, I can design it in a way that would maybe, I don't know, embezzle money from the company, or direct or let's say channel certain assets to for my own benefit without anyone knowing, because I will be the one also using that system. You cannot also, for example, place an order and approve of that order. You cannot be handling cash and counting and handling the cash register as well. Documentation procedures, once again, and checks should be, for example, numbered and all accounted for, etc. And with regards to segregation of duty, for example, there is also separating the accounting responsibilities from the custody of the assets. Like we said, one employee would handle cash, while another employee should handle cash registers, and we'll talk about that a little bit later on. Physical controls. This is the use of locked warehouses to avoid theft of inventory, use of passwords to avoid access to unauthorized access to information, the use of security cameras, alarms, like those alarms that would prevent theft, for example, whenever a tag is removed or something like that. Of course, not leaving cash in an open area or accessible to multiple people. Checks also the same way, etc. So those are to actually safeguard the assets and to enhance the accuracy and reliability of accounting records. Independent verification. For example, with independent, like when we were talking about the perpetual inventory system, while the system is calculating the ending balance of inventory, it is also a good control measure to physically count the remaining inventory on hand to see whether the numbers that are as per the company's books are the same as the inventory that is still on hand. In this case, those are two different this is basically a different verification method. Usually most companies, they use internal auditors because they in order to evaluate and examine the effectiveness of the company's internal controls and to basically verify information in the accounting records. So for example, it is always a good practice to have surprise visit or periodical audits, even for internal purposes. This is, for example, the accounting employee. In this case here, the accounting employee would who maintains the cash and later on gives the cash to the company. That would give the for example, the internal auditor or the assistant treasurer, it would give them the amount of cash that is supposed to be there according to the company's books. And then we have the cashier who actually maintains custody of the cash, who has the cash, would give the cash deposit slips to the treasurer, and the two amounts should be the same. Otherwise, that would indicate that some cash was basically stolen or disappeared or lost. And the last principle is human resources. By this we mean like background checks, bonding employees, because the insurance would be and letting them know that the insurance company would be suing them if they conduct any fraudulent activities, rotate and mandate vacations, because several fraudulent activities were discovered by this mandatory vacation. Because once you are away and someone else is doing your job, any abnormal behavior, any fraudulent activity would be, most fraudulent activities and abnormal behaviors would be detected. Now, like we said before, internal controls are not foolproof, and it is very important to understand that that in order to comply with the regulations, it's enough usually to provide some kind of a reasonable assurance. And by reasonable assurance, we mean that you'll be, for example, 95% sure that the numbers, the accounting records are accurate. Because in order to be 100%, to provide 100% assurance, the cost would be prohibitively expensive. So it could be very, very expensive to the company to conduct such a thing. Take, for example, if the company tries to stop shoplifting. Now, it is possible to stop shoplifting by asking, for example, having a security guard or ask all the customers to open their bags, and by searching their belongings, etc. Which doesn't, although it will stop shoplifting, however, it will also most probably cause the company to lose its clientele, because the customers will not accept being subjected to such scrutiny or such strict search or such strict control measures. As a result, the cost would be much higher from the benefit that the company would get from providing such level of control. Instead, the companies would take advantage of security cameras. They would have additional employees who would look around and basically see what the customers are doing. They would also have those tags and alarm systems that would go off if someone tries to take something without removing the tag, etc. Another thing that could happen sometimes is the human factor. We are human, and human beings are prone to mistakes, so they will make a mistake. They can be tired, negligent, etc. There's also collusion. We said that, for example, segregation of duties would help in providing a certain level of internal control. But what if the person who requested the reimbursement and the person who approved of the reimbursement are colluding? Collusion, we mean by that, it's when they are both in it together. So if they work together in order to steal this money, they will be able to do that. And of course, in certain cases, the company's size will play a role in limiting the effectiveness of internal controls. Certain companies are too small to have multiple employees and to have an effective or good segregation of duty. In certain cases, it's just one person who is doing all the accounting work, all the bookkeeping for the company, and at that point it may be very hard to implement a good segregation of duty controls. Those companies also, they might be too small to have an internal auditors or internal verification, so that would also affect or limit the effectiveness of internal controls. When we talk about cash, we also mean checks, money orders, coins, basically any cash that is on hand. And usually cash, companies would receive cash when they conduct a business in cash. For example, they provide a service for cash, or they make a sale directly for cash. Also, when they collect the debts of their customers. In other words, when they collect accounts receivable, when they receive interest sometimes. So when they take a loan from the bank, all these, they can generate cash to the company depending on the way it was paid. And because cash can be converted to any other asset immediately, and it can also be concealed and transported easily, it is one of the most susceptible assets to fraud. This is why companies are very concerned about cash. Again, simply because it is easily transferable and concealed, etc. Now we will talk about how the control principles apply to cash receipts. So we have, again, establishment of responsibility. We need that to make sure that only the for example, one employee is responsible for the cash at a certain point of time, in order to make sure that if cash goes missing, we can trace it back to the person who is responsible for this. We need to make sure that the person who handles the cash would be different from the person who handles the cash register. So the persons who record the cash would be different from the persons who receive cash or handle cash. This is segregation of duty. The third one is documentation, to make sure that to ensure, for example, that cash registers are available, deposit slips, etc. And then we also have independent internal verification, like internal auditors conducting audits, supervisors counting checks, counting cash receipts, etc. Human resources are the same, conducting basically doing background checks, mandating rotations or mandating vacations, bonding employees, and physical controls include, of course, the use of safes and locked drawers and locked rooms so that we wouldn't leave the cash laying around. Now, there are basically two kinds of cash receipt controls. We have the first one is when we have the over-the-counter receipts. So it depends on the way cash is received. So over-the-counter receipts is usually when the company makes a sale over the counter directly. At this point, when a cash sale is conducted, the clerk would ring up on the cash register. The clerk would ring up the sales with the amount visible to the customer. Now, this prevents the cashier from changing or from manipulating the number or charging or ringing up a lower amount and basically taking the difference. And the assumption here is that the customer will be looking at the screen and making sure that the amount that is returned by the clerk is correct. And then at the end of the day, the clerk would send the cash to the cashier, who would prepare deposit slips and deposit them at the bank. So they would send the cash and the deposit slip to the bank, and then they would send a copy of the deposit slip to the accounting department. Now, the cash register tape, which is locked, and the clerk or the cashier, neither the clerk nor the cashier have access to that cash register tape. Only the supervisor can remove that cash register tape, and this will be one line. This would be one line of information. And then the second line of information that would get to the accounting department would be from the cash register that the supervisor would remove and would send it to the accounting department. The two amounts, the one from the cash and deposits, from the information from the deposit slips and the information from the cash register should be equal. Otherwise, that would indicate there was some cash missing. The other type of cash receipts would include mail receipts, and in this case, this is when cash is when the customers are paying by checks. Any checks that are received must be opened by two people. This is to make sure that no one just hides a check. So basically, cash is the checks are opened by two people. And then those two employees would prepare a list of checks, and they will endorse each check as for deposit only. Now, the reason why it is endorsed as for deposit only is because once endorsed like that, the bank will only deposit it to a bank account and will not cash it to anyone. So the list would include the names, amounts, the purpose of the payment, basically the name of the person paying or the party paying the check, which is also called the check issuer. So basically it lists the name of the check issuer, the amount, date, as well as the purpose of the payment. This list is signed by both clerks in order to make sure that it can be traced back to them in case of any error, and then a copy, the original copy will be sent along with the checks, with the endorsed checks to the cashier, and another copy of the list is sent to the accounting department for recording. Now the clerks would also keep a copy for themselves. Here, the control is in the form of having two persons. So unless the two clerks are colluding, this is a good control. In addition to that, the customer themselves would act as a secondary control, because if the amount is not, if the customers do not see that their debt has decreased by the amount that they paid, they will contact the company and complain about that issue, at which point it can be traced back to those employees. Now that was with regards to cash receipts. As far as cash disbursements is concerned, and cash disbursements means cash payments, the companies usually prefer to make payments by checks, because it is much easier to basically channel cash or to fraud when it is paid by cash rather than when it is paid by checks. And in general, companies would use either a voucher system where they are paying by cash, or a petty cash fund. Now before we talk about those two methods, let's see how the control principles apply to cash disbursements as well. Here again, establishment of responsibility. We need to make sure that only people who are authorized to sign the checks have access to them and can sign them. For example, segregation of duties, again, that the people who sign checks, they do not also record the disbursement to avoid any foul play here. People, for example, who approve and make the payments should be different. Documentation procedures to make sure that we have the checks are numbered and they are all accounted for. No payments are done without invoices, etc. Independent verification, once again, to compare the checks to invoices and to reconcile bank statements. Human resources, same thing. We have doing background checks, mandatory vacations, and of course bonding the employees who handle cash payments. Physical controls, again, not to leave cash or checks laying around, instead having them locked in a safe place or somewhere with limited physical access, and access only to, and to be accessible only to those who are authorized to sign those checks. So the first system is the voucher system. This is a mechanism of payment. It is basically a network of approvals. So what we mean by that, it is a chain of basically authorized people signing off on that voucher until it is completed and paid. At this point, we know for sure that the proper procedure was followed. So the voucher is an authorization form that is prepared for every expenditure except the ones that are paid by petty cash. And usually it starts by filling out the information about the liability on the face of the voucher, and then an employee in accounts payable will record the voucher in a voucher register to make sure that the liability is registered. Next, the company will issue and send the check on the due date. So the employee in accounts payable will record the voucher and will file it, will record the voucher in the voucher register and will file it based on the due date. Then the company, on the due date, the company will issue and send the check out, and they will stamp at the same time the voucher as paid in order to avoid using the same voucher to be paid the second time. Once the voucher is paid and it is registered, it is sent to the accounting department to be recorded in the check register. Here, there are two journal entries that are usually made. One is when one of them is to record the liability when the voucher is issued, and the second one is to record the payment of the liability. The second kind of cash disbursement control is the petty cash fund, and this is usually done for very small amounts. So while companies prefer the voucher system, because unless all the people involved in this procedure are colluding and they are basically teaming up against the company to steal money, which is very unlikely, it is harder to make unauthorized payments. However, this is efficient and useful when you have larger payments. When you have very small payments, like for example, if the company is paying for postage to post a letter or something like that, they are unlikely to go through the voucher system. Instead, they use something called the petty cash fund. This is mostly for smaller amounts, and the way this is done is there are 3 steps involved. The first step is where the company will will basically establish the fund, and by that we mean that the company will decide who is the person authorized to approve payments from that fund, who is the custodian of that fund, as well as the amount to be in that fund. So it's the custodian of the fund as well as the size of the fund. The second step is when they make payments, basically payments using this fund. At this point, based on the company's policies, a payment would be made and then on pre-numbered petty cash receipts. So no journal entries will be entered at that point. They make the receipts and they record them on pre-numbered receipts. So they make the payments and they put them on pre-numbered receipts. Once the fund reaches a minimum, the custodian of the fund will request replenishing or restoring the fund to its original size. At that point, they will send the request to replenish the fund as well as all the accompanying receipts to the treasurer, who will be verifying the information, and if everything is okay, they will restore or they will replenish the fund at that point. So let's look at this example here. This is an example where we are establishing where the company establishes a petty cash fund. So if Laird Company decides to establish a $100 fund on March 1st, the journal entry is here. The account that will be debited is called petty cash. So petty cash will be debited $100, and because the company used cash to establish this account, cash will be credited $100. Now this is only for the establishment of petty cash. Later on, petty cash will not be involved in any journal entries unless it is, for example, the size of the fund will be changing. For example, let's say if the company decides to increase the petty cash fund from 100 to 150, there will be another journal entry where we debit petty cash 50 and we credit cash 100. Now, assume that on March 15th, Laird's petty cash custodian requests a check for $87. The fund contains $13 cash and petty cash receipts for postage $44, freight out $38, and miscellaneous expenses $5. The general journal entry to record the check will be: remember that when those transactions were made, no journal entries were made. We were only using those petty cash pre-numbered receipts where the to record those the usage of that money. But when it reaches a low, the custodian will request a check to replenish it to its original state. So in this case, for example, the amount here is the amount that is on hand. It is $13. The original amount was $100. This is why the amount that the custodian will have to request will be 100 minus 13, which is 87, and this is the amount that is requested by the custodian. And at this point, the journal entry that the company will make would include a debit to postage expense, $44, a debit to freight out, $38, and to miscellaneous expenses, a debit of $5. On the other hand, the cash that the custodian the cash account will be credited $87. This is the amount of the check that will be written out to the to replenish the petty cash fund. In this case, as you can see, we had those three payments, which were, for the total of these payments was $87. Now, in certain cases, the company might have either more cash or less cash in the petty cash fund than there is actually in the petty cash fund. It's so basically they might have more cash or less cash than it is supposed to have. So assume that Laird's petty cash custodian has only $12 in cash in the fund, plus the receipts as listed before. So we have those three receipts. The amount of those three receipts is $87. However, here we have only $12 in the cash in the petty cash fund. So the custodian will always request 100 minus whatever is in the petty cash fund. So this is why they will request $88 and not $87. However, they have receipts only for $87. In this case, there's basically a dollar missing, and at this point, the company will use an account that is called cash over and short. It is debited when there is a shortage in the petty cash fund, and this account could be either miscellaneous revenue or miscellaneous expense. In this case, it is a miscellaneous expense because it was short. So the amount of cash that was in the petty cash fund was short of $1. Here, the cash will be credited $88. This is another example of a petty cash transaction, a petty cash fund journal entries. So Batyr Company established a $50 petty cash fund on July 1st. On July 30th, the fund had $12 cash remaining and petty cash receipt for postage $14, office supplies $10, and delivery expense $15. We need to prepare first the journal entry to establish the fund on July 1st, and then the one that is used to replenish the fund on July 30th. So the first journal entry is to replenish fund, and as we said, at this point the company would debit petty cash fund 50 and would credit cash 50. So this was to establish the petty cash fund. Next, in order to replenish the petty cash fund, the custodian will need to request the original amount 50 minus whatever is remaining on hand. So that would be $38, and this is the amount that will be later on credited to cash. For next, we need to, so the company would debit the expenses. Here we have postage expense, office supplies, and delivery expense. So those expenses would be as well as the purchase of office supplies. It will be postage expense, office supplies, and delivery expense will be debited 14, 10, and 15 respectively. And then, so those were the payments that were made in using this petty cash fund. We know that cash will be debited $38. However, those, they are for the value of $39, which is to mean originally the company is the custodian is supposed to only have $11, but in this case they have $12 in the petty cash fund, which is to mean they have an extra dollar in the petty cash in the fund. This is why the company will credit over and short $1. In this case, cash over and short will be reported as a miscellaneous revenue, and cash will always be credited the original petty cash fund size minus whatever is remaining on hand, which is 50 minus 12. Now we'll get to the usage of bank as a control feature. So banks are good because they provide us with they provide the company with the means to minimize the amount of cash that is on hand. They provide also with the company with better safes, etc., so they can safeguard the cash. In addition to that, they create a double record of the which can be used also to reconcile when we reconcile the company's records with the bank's records, it would act as an additional control. And this is why it is very important that the person doing the reconciliation of the bank accounts would be different from the people who have recorded or handled cash, in order to make sure we have a proper segregation of duties. So the control features of a bank account do not include, which one of these do they include? They do not include having bank auditors verify the correctness of the bank balance per books, minimizing the amount of cash that must be kept on hand, providing a double record of all bank transactions, safeguarding cash by using the bank as depository. The correct answer is A, because the bank auditors will not be they will be looking they will not be verifying the company's books. They will be verifying the bank's books, but this is not a control feature of the company itself. This is a control feature probably of the bank, but not the company. Now, the bank reconciliation is important because it is very unlikely to have the company's books, the company's cash account per books, and the company's cash balance according to the bank statement to be the same. And there is a reason for that. This is why it is very important to reconcile the two accounts to make sure that nothing is wrong. Now, if we think about it, the reason why the balances might not be the same is that, for example, there are certain transactions that the company, the time of recording them and recognizing them by the company is not the same as the time of recording them and recognizing them by the bank. For example, when the company makes a deposit, the company will not add that to the bank account until like, for example, the bank clears the check, etc. As far as the company is concerned, they have recorded the deposit, but as far as the bank is concerned, they will not record it until later on. On the other hand, there are also the outstanding checks. Those are the checks that the company has already issued, and because the company issued those checks as payments to their, for example, suppliers, the company will record them as already paid, and at that point they will be crediting their cash balance. But the bank will not actually pay those checks until they are clear, until they receive them. So usually it takes a while, but from the time that the company issues the checks until the check is sent and received by the supplier. For instance, the supplier will deposit them at their bank will try to clear them with the company's bank. So during this time, the company would have already recorded the payment, but the bank would still would still have not paid that amount yet. And this is why we have those, for example, the deposits in transit and outstanding checks, in addition to all the charges that the bank will charge the company, for example, like service fees, check printing, interest, or for example any changes if there was if the company earned interest. They will only see those bank memoranda at the end of the month, and this is why those three kinds of instances, they would create a time lag between the time the company between the timing of recording between the company and the bank. In addition to that, there are also sometimes errors either at the level of the company or at the level of the bank, and those are usually need to be adjusted as well once during the bank reconciliation. So in order to make sure that the company's records are correct, both the bank account, the balance per bank and the balance per company's records must be adjusted to reflect the correct and the real cash balance. So whenever we are trying to when we do this reconciliation, the procedure is to, for example, to do them in parallel. So for example, we first have the balance. So we have the balance according to the bank statement, and we have the balance according to the company's books. The bank, according to the balance, the cash balance according to the bank statement, that we need to make the following adjustments so that it would reflect the correct balance. We need to add the deposits that the company that are in transit. So for example, the pending deposits, etc. We need to add those, and we need to subtract the outstanding checks. Those are the checks that the company issued but the bank has not paid yet, and any bank errors if they happen. Now, we are not saying that we are going to make those journal entries for that. Those are calculations so that we would get from the balance on the statement from the bank to reach the correct balance. On the other hand, the company's books must also include certain adjustments, because we also have the notes that the company, those are notes receivable, for example, that the company might collect on the company's behalf. So we need to add any amount of cash that is collected by the bank. We also need to subtract bounced checks, or NSF, not sufficient funds. So the NSF funds, NSF checks, or the not sufficient checks, the not sufficient funds checks that will bounce, they will have to be also subtracted, because the company originally would have recorded that check as a debit to cash, but because they bounced, and those are the checks that the company has received, not the checks that the company has issued. So when the company receives a check from a customer, if that check bounces, the company will have to adjust the balance per books in order to deduct that amount from the cash balance, because at that point it recognizes that it did not actually receive the cash payment. Also, the company will have to take into consideration any charges or any bank memoranda, plus to fix any errors in case if they have occurred, that in this case they will get from the per books balance to the correct balance. Those two balances, they have to be equal, otherwise if the reconciliation would not happen. This is an example of a bank reconciliation process where we try to where we start with a cash balance per books and the balance per bank, and we try to get to the correct balance. Here the company has the balance per bank and the balance per, so we have the balance per bank and the balance per books. In addition to that, the company has these 4 steps. Those are the steps that we discussed earlier. So we have deposits in transit, outstanding checks, errors, as well as bank memoranda. So the way to deal with this is to start with for example, we have to get from the bank balance to the correct one, which will be used as a reference to compare the adjusted cash balance per books. So we start with the bank with the balance per bank. We get to the adjusted and correct balance, and then we use this correct balance as a reference to verify the amount that we will find as adjusted cash balance per company's books. So we have those deposits in transit, outstanding checks, errors, and bank memoranda. So we do that one by one. First, we start from the cash balance per bank. From what we saw before, for the cash balance, we always add. So we start with cash balance and we add deposits in transit. We subtract outstanding checks, and we fix errors. So let's go back here. We have deposits in transit for the amount of 2,201.40. Those are deposits that the company has recorded but the bank has not recorded yet. As a result, we need to add those. So we need to add those. Outstanding checks, those are the checks that the company has issued for payment but the bank has not paid yet. We need to subtract those. And then errors, let's look at the error. Laird Road check number 443 for $1,226, and the bank correctly paid the amount. So the error here was done by the company. So here the bank will have does not have any errors. The bank memoranda, as you remember, this goes on the adjustments of the balance per books. Here, this is why we need to add deposits in transit. We subtract outstanding checks, and because we didn't have any errors, that would give us the amount, the adjusted amount here. Now let's at the same time let's do the cash balance per books. We started with the unadjusted balance, so this is unadjusted balance. We need to fix the errors. So from this one here, the companies, so we did this one, we did this one. The error here was for the amount of $36. The company had recorded the payment as $1,262. So the company had credited their cash balance $1,262, whereas the bank only paid $1,226. As a result, the company will need to add this amount to their bank because they thought that they paid this amount, but it was not paid. We will get to that one in a second and we'll explain it in more detail. And then we needed to we'll look at, so for this one here we also need to, so we need to fix errors. Basically we need to subtract not sufficient fund checks, which are the bounced checks. We need to add any notes collected by bank. We have to take into consideration bank memoranda, so we need to add, we need to subtract any charges by the bank, add any interest, etc. that was earned, and we need to fix errors. So let's see here what we had. we had an error, so this one needs to be done here, and then we had NSF check, we had a charge, and the bank collected note receivable for 1,000, and the interest on that note receivable was $50. So the company was supposed to receive basically received $1,050, but the bank also charged a collection fee of $15. So the amount that was earned, the amount that was collected from the note receivable is 1,000 plus 50, that was the interest, minus the 15, which is the fee. So the collection fee is this one, and this one is the interest that was earned. So as a result, the company will add to its cash balance $36 to fix the bank error. The company will subtract the bounced checks, NSF checks will be subtracted, and we also had bank charges for the amount of $30. This is not the amount that was from the collected note. This was the charges that the bank charged the company. And finally, we had collection of notes receivable for the amount of $1,035, which was $1,000 plus $50 minus 15 as a collection fee. As a result, we calculate the two amounts and we see that they are the same, which means that they have reconciled and that the company's records are correct. So this is when we look at the two amounts here, and we see that the company's reconciliation was in fact the records of the company were in fact in order. And this is the presentation of the bank reconciliation, where we have this part is for the cash per bank statement, and this is for cash per company's books. And we have, this is where we added the deposits in transit, and we subtracted outstanding checks. For the adjustments of the cash per books, we have, this was the unadjusted balance. We added the note receivable, the error, we fixed the error in check, and then we subtracted the bounce checks as well as the bank service charges. So with regards, going back to our to the check part, the company wrote the check correctly for the amount of $1,226. The bank paid correctly the amount of $1,226. The company recorded the check incorrectly for $1,262. So when we are trying to figure out whether to add or subtract the error in the check, let's assume, this is just an assumption, that the company's unadjusted cash balance was $1,300 and that there was only this adjustment. So let's say that this is cash per bank. So the cash account was originally a debit of $1,300, and cash per book, it was again $1,300. Here the company, the bank paid and recorded it correctly as $1,226, which is to mean, according to the bank's balance, the amount was $74. So this is the ending balance of cash as per the book. as per the bank's balance, and this is the correct amount. As far as the company is concerned, they recorded the transaction incorrectly as 1,262, which led to an ending balance of 38, and this is incorrect. So the company thought that they had $38, whereas in reality they were left with $74. As a result, we have 38. So we have $38 plus the adjustment should be equal to 74. So the adjustment is equal to 74 minus 38, which is equal to 36. And this is why we added the 36 to the cash account at that point. Now the company will have to make adjusting entries for all the adjustments that we made for the cash balance per books, but not for the cash balance per bank, because that was related to the bank's records, and the company will not be making an adjusting entries for the company's journal. However, for the bank's journal, the company will be making will need to make adjusting entries for all the adjustments as per the cash balance per books. Here, for example, the journal entry for the collection of note receivable will be, assuming that the interest has not been accrued and the collection fee is is debited to miscellaneous expense, the company will make an adjusting entry where we debit cash 1,035, we debit miscellaneous expense $15, and we credit note receivable $1,000. At this point, the company has also earned an interest revenue of $50. This is why we were talking about that the interest has not been accrued. It has been earned directly. So at this point, both sides, total debits and total credits, are equal. Now the journal entry for the bank error, where we added the amount to the check, it will be to debit, because we need to increase cash by $36, we debit cash $36 and we credit accounts payable $36, because the company at this point they thought that they paid $36 more of their liabilities, but they did not. This is why their cash has increased, but at the same time their liabilities, they had to also increase, because at this point the company did not make this payment to their As a result, they did not settle that amount of their liability. So we debit cash $36, we credit accounts receivable $36. The second one here is for a bounce check. The company originally would have recorded that as a deposit, so they would have added that, they would have debited cash and credited accounts receivable. At this point, we need to reverse the entry, so the company would debit accounts receivable $425.60 and credit cash $425.60. This is basically to reverse the recording of the payment that was made earlier using that same check. As far as the bank memoranda are concerned, the bank had charged the company printing charges as well as other charges for the amount of $30. So miscellaneous expense here is $30. It was debited $30 and cash was credited $30. As a result, this was the beginning balance. This is check error. This is the error in check. This was collection of note This one was the bounced. This one was the bounced check, and this one, those were bank charges. This is the adjusted balance of cash according to the company's books. This is another example where we have an error in recording a check. So the check was correctly written by the company and correctly paid by the bank for the amount of $491. So this is the correct. So this is the correct amount, but it was incorrectly recorded by the company as 419. So this one is incorrect. Okay, let's do it in the same way as we did before. We assume for simplicity's sake that the beginning balance of cash was 491. So as per bank, cash balance was 500. The bank made a payment for 491, so it credited the account of 400, so it decreased by 491, and the balance would be $9. That's the correct one according to the companies. Per book, cash was again 500. The company recorded the payment as 419, and that would give us an incorrect balance of 81. So this amount was incorrect. Now, generally speaking, you have the incorrect plus the adjustment should be equal to correct. Here, 81 plus the adjustment is equal to to 9. The answer would in order to balance to adjustments. Okay, and here remember, what we are making adjustment for is the cash balance and not the payment. So the adjustment is for the cash balance and not the payment. So you cannot here, for example, you cannot here for 419 instead of have here here the adjustments for the cash itself. With regards to reporting cash, many companies they report cash and cash equivalents under current assets as the first item because they are the most liquid assets, and cash equivalents are usually short-term assets that are highly short-term investments that are highly liquid. And the reason why they are called cash equivalents is that they can be readily converted to cash. So basically you can convert them to cash almost immediately, or they are so near their maturity date that it is basically relatively safe to say that the interest rates will not change by the time they are converted to cash. The companies also report restricted cash, which is cash that the company owns, but they don't have the right to use, because sometimes, for example, this could be used as a leverage if the company is borrowing money from a bank, for example, or from someone. They might ask them to have some restricted cash in order to make sure that the company will be able to pay back part of their debt or something like that. So while the company has while the company owns this kind of while the company owns this cash, it is still restricted and they don't have the right to utilize it. So this is here, for example, you have current assets, we have cash and cash equivalents because it's the most liquid asset, and then after short-term investments we would have also restricted cash. Here, Amy Company assembled the following information in completing its July bank reconciliation. So here we're trying to do a bank reconciliation, and we'll see what the company has to do. So in July, the balance, we have the balance per bank. Whenever you have a question like that, you have two parts. You have the bank and per books. So this is per bank and this is per company's book. We have cash. The original, we have the original amount. Here it was 15,280. We add deposits in transit, 5,000. We subtract outstanding checks, and we have no errors, so we just, so basically because we don't have any errors, we just add them up and subtract the 3,100. That would be 17,180 per book. So this was per bank. Per book, we start from 17,600. So this one was done, this one was done, this one was done. The company, there was an SF check for 320, so we need to subtract 320. Bank service charges were 100. We subtract that as well, and there were no errors, so we complete the calculation, and this is also 1,780. 17,180. Those are equal, so we know that the records are correct. As a result here, let's see. Did the company reduce its cash amount by 1,900? No. Did the company reduce its cash amount by 420? Actually, yes. So this is the correct answer. The company reduced its cash by 420, which were from the bank services, 100, and the check that bounced, 320. That concludes this chapter, and basically we have learned how to, in addition to, we talked about internal controls, and also we learned how to do bank reconciliations.